Your credit score isn't just a number, it's the key to unlocking better apartments, lower car loan rates, premium credit cards, and thousands of dollars in savings. And as we head into 2026, the credit game has changed dramatically, which means you need a fresh strategy to win it. I'm going to show you exactly how to dominate your credit score in 2026 with tactics most people don't even know exist yet. Welcome back to the channel. Today, we're diving deep into the 2026 credit landscape and what's different from previous years, the critical mistakes that are destroying scores right now, 9 proven strategies to boost your credit score fast, including how to leverage new scoring models, rent reporting, and alternative data that most people don't even know about. Stick with me until the end, because missing even one of these tactics could cost you thousands in higher interest rates. Here's what you need to understand. The credit scoring world in 2026 is completely different from even 2 years ago. As of early 2025, the national average FICO score dropped to 715, and it's been trending downward as economic pressures mount and student loan reporting resumes. But here's the opportunity. While traditional FICO scoring still dominates, powering decisions for about 90% of top US lenders, the game is evolving. Your FICO score is built on 5 pillars. Payment history, roughly 35% of your score. This is your track record of paying on time. Credit utilization, about 30%. How much of your available credit you're actually using. For example, if you have a $10,000 total credit limit across all cards and you're using $3,000, that's 30% utilization. Length of credit history, approximately 15%. How long your accounts have been active, new credit inquiries, around 10%. How frequently you're applying for new accounts, credit mix, about 10%. The diversity of your credit types, cards, auto loans, mortgages, etc. Now here's what's critical for 2026. New models like FICO 10T and VantageScore 4.0 are being adopted by major lenders, and these models can include alternative data like rent payments, utility bills, and even telecom payments. This means more opportunities to build credit, but also more ways to damage it if you're not careful. Let me be crystal clear, 2026 isn't business as usual. Look at how fast things have changed. Student loan forbearance in 2021, new scoring models launching in 2023, buy now pay later tracking starting in 2025, and now full integration in 2026. Here are the game changers. Student loan reporting is back. Federal student loan delinquencies are now being fully reported again after years of forbearance. This has already caused score drops for millions of Americans, and more delinquencies are expected as 90-day past due reports continue rolling in. Alternative credit data is now mainstream. VantageScore 4.0 includes rent, utilities, and telecom payments in scoring. This is huge for people with thin credit files or those rebuilding their credit. Mortgage industry changes. Starting in 2026, lenders can choose between Classic FICO and VantageScore 4.0 for mortgage applications, creating more flexibility but also more complexity. Trended data matters more. FICO 10T now looks at how you've managed debt over 24 months, not just a snapshot. If you've been consistently paying down balances, that pattern now helps you. If balances keep climbing, that hurts more than before. For example, Person A carries a $5,000 balance every month and only pays minimums. Person B also has $5,000 but pays it down to $1,000, then back up, then down again. Person B will score better because they show responsible debt management over time. Buy now, pay later, BNPL, tracking. Major scoring companies are incorporating BNPL data. Those harmless 4 payment plans? They're now part of your credit profile. The bottom line, playing small games or ignoring these changes will cost you. But understanding and using them strategically? That's your competitive advantage. Payment history is king at 35% of your score. Rising missed payments are driving score declines nationwide. Your action plan: set up autopay immediately for the minimum payment on every credit account. Create payment reminders 7 days before due dates. Pay in full whenever possible to avoid interest. If you've already missed a payment, call your lender immediately. Many offer one-time courtesy removal if you're otherwise in good standing. For example, if you're 15 days late on a $50 chase payment, call them, explain it was an oversight, pay immediately, and ask for goodwill adjustment. They often remove it, especially if it's your first time. One 30-day late payment haunts your report for 7 years. Protect your payment history. Credit utilization is your second biggest lever. Average utilization jumped to 35.5% in 2025, up from 29.6% in 2021. Your targets, under 30% is baseline. Under 10% is where premium scores live. At 50% utilization, you're hurting your score. At 30%, you're acceptable. But at 10% or below? That's where the top scores live. Pay before the statement closing date, not just the due date. Your statement balance gets reported to bureaus. Example, statement closes on the 25th, payment due on the 15th. Most pay on the 15th. But if you charge $2,000, that gets reported on the 25th, even if you'll pay it off. Make a payment on the 23rd instead. That lower balance is what gets reported. Pro move: if you can't pay down balances immediately, request a credit limit increase to instantly lower your utilization ratio. If you're starting from zero or rebuilding, you have 4 proven pathways: secured credit cards, credit builder loans, alternative credit services, or becoming an authorized user. Each can boost your score by 30 to 80 points in just 6 to 12 months. Secured credit cards: deposit $200 to $500, use responsibly, pay on time. Example, deposit $300 with Discover. Spend $30 monthly on gas, pay in full. After 8 to 12 months, they return your deposit and convert to unsecured. Credit builder loans: credit unions offer $500 to $1,000 loans designed to build credit. Alternative services: tools like Experian Boost, Self, or Kikoff help build credit using bills you're already paying. Pick 1 to 2 products, use sparingly, under 10% utilization, pay on time, let time compound. Authorized user strategy: ask someone with excellent credit to add you to their oldest card. Example, your dad's Chase card from 2010 with $20,000 limit in perfect history. He adds you. Suddenly, your report shows a 15-year-old account with perfect history. Your average account age jumps from 2 years to 8.5 years, and your score can jump 50 to 60 points instantly. Guidelines: only do this with someone who has strong history, low utilization, and no missed payments. Rent reporting: Vantage Score 4.0 now factors rent payments. Use services like Rent Track, Rental Karma, or Experian Boost to report rent to bureaus. Every application generates a hard inquiry, temporarily lowering your score. Space out applications 3 to 6 months apart, especially before major purchases. Rate shopping window: multiple mortgage/auto inquiries within 14 to 45 days count as one inquiry. For example, you're buying a car and get quotes from Toyota, your credit union, Bank of America, and Capital One, all within 2 weeks. Instead of 4 separate inquiries, they merge into just one. That's how you protect your score while getting the best rate. Use pre-qualification tools when available. Soft pulls don't impact your score.
So far, you've learned the 5 foundational strategies that'll move your score fast.
But here's the thing: most people stop here and leave hundreds of points on the table. In part 2, I'm revealing 6 more advanced strategies, including BNPL secrets, audit techniques, and the psychology of credit building that nobody talks about. Plus the credit score benchmarks you need to know, and the psychological game that separates good credit builders from excellent ones.
Hit subscribe so you don't miss part 2 dropping this week. See you there.